Welcome to our deep dive on the Roth versus traditional 401k decision. First, we will set the stage and explain why this choice is fundamentally about taxes, not investment performance. Next, we will walk through the core trade-off, simple math, common misconceptions, and a decision framework you can apply. Finally, we will test your understanding with quick quizzes and wrap up with clear takeaways. Here is the plan. First, we will clarify the fundamental difference between Roth and traditional 401k. Then, we will explore the basic tax math that drives the decision. After that, we will compare scenarios where traditional likely wins and where Roth can shine. Next, we will cover rules, limits, and employer match facts. Then, we will provide a simple decision framework. Finally, we will test your understanding with short quizzes. Before we begin, please note this video is educational and does not constitute personalized financial, tax, or legal advice. Everyone's situation is unique and tax laws change. Therefore, you should consult a qualified tax professional or financial planner before making decisions. Additionally, contribution limits and ages for distributions are subject to annual updates, so always verify current IRS guidance. At the highest level, the choice is about when you pay taxes. With a traditional 401k, you get a tax deduction today, which reduces your current taxable income, and you will pay ordinary income tax on withdrawals in retirement. With a Roth 401k, you pay tax upfront, which means no deduction today, and qualified withdrawals in retirement are tax-free. The decision should hinge on a comparison between your current marginal tax rate and your expected effective tax rate in retirement. If your current marginal rate is higher than what you expect later, the traditional option often wins. Conversely, if you expect to face a higher effective rate later, Roth can be better. Moreover, remember, employer matches typically go into the traditional bucket regardless of your election. Let us formalize the idea. With a traditional 401k, $1 contributed pre-tax grows fully. At retirement, you pay ordinary income tax on the withdrawal, so the after-tax value equals 1 minus your retirement tax rate times the accumulated value. With a Roth 401k, you pay your tax now, invest what remains, and withdraw tax-free later, resulting in 1 minus your current tax rate times the accumulated value. Therefore, if your current marginal tax rate exceeds your expected effective retirement tax rate, traditional often yields a higher after-tax outcome. If your current rate is lower than your expected future rate, Roth often prevails. Importantly, these are simplified models, and your real-world situation may include variables such as state taxes, deductions, credits, and potential legislative changes. Here is a direct comparison. Traditional 401k provides an immediate tax deduction, which is valuable if your current marginal tax rate is high. Withdrawals in retirement are taxed as ordinary income. Employer matches are typically contributed to the traditional side. This setup tends to be superior when you are in a higher bracket today than you expect to be later. By contrast, Roth 401k requires you to pay taxes now, but qualified withdrawals are tax-free. Roth is compelling if you anticipate higher tax rates in retirement, value the certainty of tax-free withdrawals, or want tax diversification. Additionally, Roth can be attractive in years when your income is unusually low, such as a sabbatical or early career with low earnings. This table summarizes critical rules. First, employee contributions share one unified annual cap across Roth and traditional. Confirm the current IRS limits because they change. Second, employer matching dollars almost always go into the traditional bucket, and those funds will be taxed when withdrawn. Third, traditional growth is tax-deferred but taxed upon withdrawal, while Roth growth can be withdrawn tax-free if you meet qualification rules. Fourth, distributions are generally available at age 59 and a half, subject to holding requirements. Fifth, starting in 2024, Roth 401k balances are no longer subject to required minimum distributions, though plan administration details can vary. Sixth, you can convert pre-tax balances to Roth, but you must pay ordinary income tax in the year of conversion. Finally, rollovers typically preserve the tax character of the funds when moving between 401k and IRA accounts. Traditional tends to win when your current marginal rate is significantly higher than your expected retirement effective rate. Additionally, if you are in phase-out ranges for credits or deductions, reducing your current taxable income with traditional contributions can deliver extra value. If cash flow is tight, the immediate deduction helps. When your employer match is generous, you are already accumulating a sizable pre-tax balance. which further tilts the analysis toward traditional if present tax rates are high. Finally, if you expect to retire in a lower tax state, paying less later strengthens the traditional case. Roth can shine when your current tax bracket is relatively low compared with what you expect in retirement, and also supports tax diversification so that you can manage taxable income in retirement with flexibility. If you foresee rapid earnings growth or major income jumps, paying tax now at lower rates can be beneficial. If you are concerned about future tax increases from policy changes, Roth offers a hedge. Finally, eliminating required minimum distribution concerns and enjoying tax-free withdrawals can provide peace of mind and planning simplicity. This timeline illustrates a typical journey. In early career, income is often low, so Roth contributions can be attractive. During peak earning years, marginal tax rates tend to be higher, so traditional contributions may dominate. In the pre-retirement phase, there may be strategic low-income windows, such as a sabbatical, early retirement, or between jobs, when Roth conversions can be efficient. In retirement, the goal is to blend withdrawals across traditional, Roth, and taxable accounts to manage your effective tax rate. Consequently, the timeline emphasizes adapting your contribution choice as your tax situation evolves. When you are uncertain about future tax rates, splitting contributions between Roth and traditional can hedge your risk. Maintaining balances in both types increases flexibility when designing retirement withdrawals. In tandem with taxable accounts, you can fine-tune your taxable income in retirement to stay within desired brackets. Because income levels, state residency, and tax laws change, you should revisit your allocation annually and adjust as needed. Here is a practical framework. First, estimate your current marginal tax rate and compare it to your expected effective retirement rate. Second, consider whether you are in any phase-outs where reducing taxable income is valuable, and review cash flow needs. Third, remember your employer match is typically pre-tax, regardless of your choice. Fourth, if the current rate is much higher than your expected future rate, traditional often wins. If much lower, Roth often wins. Fifth, if you are unsure, consider splitting contributions. Sixth, avoid converting existing pre-tax balances to Roth unless you are in a low tax window and have cash to pay the tax. Seventh, maximize tax-advantaged accounts like your 401k and IRA before moving to a taxable brokerage. Quiz time. If your current marginal tax rate is 32% and your expected effective retirement tax rate is 22%, which contribution type is more likely to maximize after-tax wealth? Option 1, traditional 401k. Option 2, Roth 401k. Option 3, it does not matter. Option 4, split contributions 50-50. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is traditional 401k. Your current marginal tax rate exceeds your expected retirement effective rate, so the immediate deduction is valuable, and paying taxes later at a lower rate generally improves after-tax outcomes. Second quiz question. In most employer plans, where do matching contributions go? Option 1, into your Roth 401k if you choose Roth. Option 2, into the traditional pre-tax 401k bucket. Option 3, split evenly between Roth and traditional. Option 4, you choose each paycheck. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that matching contributions go into the traditional pre-tax 401k bucket. Those dollars are contributed on a pre-tax basis and will be taxed when withdrawn in retirement. Let us address misconceptions. First, Roth is not always better for young earners. The choice depends on comparing current and future tax rates. Second, if you change future elections to Roth, your existing traditional balance remains separate and continues to grow tax-deferred. You do not need to move it. Third, converting existing traditional balances to Roth triggers ordinary income tax now and can generate a large and poorly timed tax bill. Fourth, splitting between Roth and traditional does not change your overall annual contribution cap. There is a single unified limit. To summarize the essentials, this decision centers on tax timing rather than investment performance. Always compare your current marginal tax rate to your expected effective retirement rate. Traditional often wins when today's rate is higher, while Roth often wins when today's rate is lower. Employer matches are typically pre-tax and will be taxed later. When uncertain, diversify your tax buckets. Finally, maximize tax-advantaged accounts before investing in a taxable brokerage. In closing, remember that traditional means a tax break now and taxes later, while Roth means taxes now and tax-free later. If your current tax rate is higher than what you expect in retirement, favor traditional. If lower, favor Roth. Keep existing pre-tax balances as they are unless you have a clear, low-tax reason to convert. Finally, consider using both types to maintain flexibility in the face of future tax law changes. Before we go, please like this video, share it with someone who is choosing between Roth and traditional, and subscribe for more practical money guidance. In the comments, tell us your current bracket, your retirement expectations, and how you are splitting contributions this year. We look forward to your thoughts and questions.